What were Enron's shocking tactics during California's energy crisis? Imagine a state facing rolling blackouts, soaring electricity bills, and businesses struggling to stay afloat. Now, picture a company secretly pulling strings behind the scenes to cause chaos. That's what happened during California's energy crisis in 2000 and 2001. Enron, a giant energy company, used some sneaky tricks to make things worse. They took advantage of a market that was supposed to be fair but had loopholes. California had opened up its electricity market in 1996, letting companies trade power freely. But they kept the prices for buying and selling electricity separate. Enron saw this as a chance to make huge profits by playing dirty. One trick they used was called economic withholding. They shut down power plants or cut back on electricity production during times when demand was highest. This made it look like there was not enough power, so prices shot up. Sometimes prices went up to 20 times what they normally were. Enron also manipulated the bidding process. They submitted fake high bids to push prices higher in the spot market, which is where electricity is bought and sold for immediate delivery. They even had secret plans with names like Death Star and Ricochet. The Death Star scheme involved creating fake congestion on the power grid by sending false information about transmission lines. This made it seem like the grid was overloaded, so Enron could charge extra for fixing the fake problem. The Ricochet plan was clever. Enron bought electricity inside California where prices were capped, then exported it out of state and sold it back at higher prices. This way, they made a lot of money while California consumers paid the price. They also lied about supply and demand data to make the market look tighter than it was. All these tactics caused widespread blackouts, hurting homes, businesses, and the economy. Major utilities like Pacific Gas and Electric Company went bankrupt, and the crisis cost California around $40 to $45 billion. This scandal shows how a lack of proper oversight and regulation can turn a market into a tool for manipulation. It also reminds us that transparency and honesty are vital in keeping markets fair and stable. Enron's tricks during the California energy crisis are a stark example of how corporate greed can lead to major economic disruptions and damage public trust.